Hi viewers, Namaste. As we now know what and why about financial ratios, we are now ready to see in depth about individual ratios. In this video, let us know what is a current ratio, how is it calculated, why is it important, how to quickly check a current ratio of a company, and of course, we will learn interrupting current ratio as an investor. So, welcome to the world of Get Trading. First, what is current ratio? The current ratio is a liquidity ratio that measures a company's ability to pay its short term debts and obligations, that is, those which are due within 1 year, with its short term assets, that is, those which can be liquidated within a year. This ratio is used to assess a company's short term liquidity. What is liquidity ratio and what are other categories of financial ratios? You can find it in the video we published for it. We suggest you to watch it. Link can be found in the description box below or the I symbol above. Okay, current ratio is calculated by comparing a company's current assets to its current liabilities. That is, it is equals to current assets divided by current liabilities. Current assets. These are listed on a company's balance sheet, which include cash and cash equivalents, current investments like marketable securities, accounts receivables, inventories, etc. Current liabilities. These include accounts payable, wages, tax payable, and the current portion of the long-term debt. Okay, let's quickly see it from a balance sheet itself. The script which we are considering from many videos, Indigo's balance sheet. Let's check in moneycontrol.in. See here, 2019's balance sheet shows current liabilities as 7,999 crores and current assets as rupees 18,103 crores. So, current ratio is equals to 18,103 divided by 7,998, which equals 2.26. So, this means that for every 1 rupee of debt to be paid in short term, this Indigo has 2.2 rupees from which the debt can be cleared. Common sense can be applied here to know that this company is very comfortable in terms of liquidity, a good sign for an investor. We need not every time open a balance sheet and calculate the current ratio. You can check in this ratio tab too. Let's see our current ratio. See here, it's 2.26. Now, how to know whether this ratio is good or bad? Interpretation of current ratios. Let's see from the liabilities point of view. Everyone agrees that a company should be in a position to liquidate enough cash in short term to settle its short term debts. Now, if a company has current assets which equals to its current liabilities, then the current ratio will be 1. So, seeing this from another angle, if the current ratio is 1, it means that the company has enough assets to clear its liabilities. In other words, we can also say that the company has just enough assets to clear its liabilities. We cannot fully say that the company is comfortable as there is no cushion. But anyway, many feel that the current ratio of 1 is good when compared to less than 1. Now, if the current assets are more than current liabilities, then the ratio will be greater than 1. Also seeing this from another angle, this obviously indicates that the company is capable of paying its short-term debts. In other words, the company is healthy in terms of liquidity. If the current assets are less than current liabilities, then the ratio will be less than 1. This may indicate that the company may face problems in settling its short-term liabilities, which we can call as liquidity crunch. This may affect the reputation and business cycle of the company. Ignoring some concepts, more lower side of the current ratio is more worse for the health of a company, no doubt. That is, 0.3 is worse than 0.8. But what is it for the higher side? Is more ratio more good for the company? That is, for example, is current ratio of 5 is more good than current ratio of 2? Let's see now. Going back to the formula, here, higher ratio means either inventory is high, which may mean that the inventory is slow moving. Next, cash in hand may be more, which means that the management is incapable of using the excess cash as investment opportunities, be it in R&D, long-term assets, etc. Or also, the receivables collection could be slow, which affects the cash flow. So, that's the reason we said in our previous video that Ratios do not provide answers, they suggest possibilities. You will be able to ask the right questions and you point towards further investigation. To be specific in this current ratio, what is more important is studying the components of current assets and current liabilities, which gives a truer picture. Many analysts feel that the current ratio of 1 to 3 is a good sign. Current ratio of less than 1 is bad, and current ratio of more than 3 is also good but to be studied more. This current ratio should always be compared with the industry average because some sectors require high liquidity due to high uncertainty of operations, and for some sectors, higher liquidity is not the utmost priority of the business as operations are predictable. And again, what makes the current ratio good or bad often depends on how it is changing. A degrading current ratio over time would be expected to have a negative impact on the company's value. So, investors may not be keen in this company. An improving current ratio could indicate an opportunity to invest in an undervalued stock. Now, in this formula and in terms of liquidity, everyone accepts that the cash is the most liquid asset a company can have, right? Accounts receivable are less liquid compared to cash in hand, as they will be converted into cash once the customer pays the company. But this inventory, this is less liquid compared to these two, as if it is a raw material, it should be converted into a finished good and then sell it later. Or if it is a finished good, it must be sold first. Even after selling, the company may be forced to be on credit terms. So, sometimes this current ratio may not fully reflect the company's liquidity due to this inventory. So, what if we do not consider this inventory in getting the liquidity? We can then see how quick a company can pay its liabilities, right? If this is made, it is called as quick ratio, which we will see in the next video. Please stay in touch with us. How? By subscribing to our channel and pressing the bell icon on the right. Have a happy, safe and profitable trading. Jai Hind.